G'day, my name is Elfreda Jonker and I'm the Client Portfolio Manager at Alphinity Investment Management. Today I have Martin with me, one of the founders of Alphinity, one of the Australian portfolio managers as well as the analyst on the financial sector. Today we will be talking a bit about the Australian banking sector and the outlook from here. So Andrew, as a starting point, we've just finished the reporting season. Can you reflect on some of the key themes that's come out of that?
If we look at the absolute results for the banks, they're actually really good. They had double-digit type growth. Top line's growing really strongly given what interest rates have done. The issue really wasn't the absolute results, it was the relative results, and the market had expected slightly better. So all the banks actually missed earnings by a couple of percent, which led to sort of mid-single-digit type downgrades and a negative reaction to the share prices. So the key thing that was the real negative surprise came around through what's called net interest margins for mortgages. So think of it like the price that people pay for mortgages. There's been a lot of competition in the market for mortgages, lots of discounting. Now we all knew that, probably ended up being a little bit worse than expected, but what really caught us by surprise wasn't the price for new mortgages, it was actually the price for what they call the back book. So this is existing mortgages in the market.
Okay, that's repricing.
That's right. So what happened is that the banks had this huge surge, particularly in the last quarter, of people phoning up their bank saying, I'd like a better price. Interest rates have gone up, things are getting tight, I want a better price, and I've heard there's good discounting in the market. And the banks were actually willing to give them that price because of the heightened competition in the market. It's better to pay up to keep an existing customer than have to go and get a new one.
Yes.
The number of people that did that and the size of the discounts they got was just way bigger than the market expected, and that pressured margins. Now we've heard anecdotally that some of that's now easing up, both front book and back book, but early days, we'll have to wait and see that. I guess lastly, looking at the major banks, there wasn't really any differentiation between them. It was all the same themes. They all missed the boat a little bit, they all got some downgrades. Probably the one positive thing to come out of it was capital. So they all came out with a lot more capital than people expected. So there's a lot of excess capital and maybe capital management coming down the track.
So still stacking up relatively well to the global banks, if you do that direct comparison.
Yes. Yeah.
So just from here, what is the outlook for the banks from here onwards? And what are some of the sort of bigger risks, if you can flag, for the sector?
Yeah, there's probably two major risks. So we've spoken about mortgage competition. The big risk going forward is actually deposit competition. So the banks have made a lot of money on deposits given interest rates have risen. One of the reasons they've been happy to compete on mortgages is because they've done so well on deposits. That's starting to change, and so you're starting to see competition on deposits now coming through. Not a deluge, but it's definitely coming through. So that's something to be watched, because even if mortgage competition comes off, if deposit competition increases, that'll more than offset it. The second one is to think about the risk from credit quality. So this is people being able to actually repay their loans. So to date, credit quality has been way better than people expected.
Okay, even with the higher interest rates.
Even with high interest rates, and you can see it in the economy. The economy's held up better. Unemployment's still very low. Therefore, people have continued to pay down their debts. The issue is, are we at that point now with where interest rates are that we start to see that impact come through? And if we don't see that impact, that perhaps the central bank has to go even harder, and then creates that downturn. So the risk going forward, even though we haven't seen it yet, is that eventually we're going to start seeing more people not being able to pay their loans. And we all expect that. The risk is that it's worse than expected. But even more than that, from a sentiment point of view, once you start to see a credit cycle deteriorate, for banks, it's usually a pretty negative sentiment thing. So those are probably the two things I'm thinking about from a risk perspective going forward.
Okay, so all of that being said, and quite a few risks there, how are we currently positioned specifically in the banking space?
Yeah, look, we have been changing. So if you think about last year with interest rates going up, we were long the banks and did well out of that. As we've come into this year, the risks have increased. We've spoken about a number of them already.
Yes.
Very important for us is that with this latest reporting season, with those downgrades coming through for the banks, that upgrade cycle we saw in earnings through last year is well and truly gone. And so for us, the risks have now turned the other way around. There's a number of headwinds. We've spoken about mortgage and deposit pricing, potentially credit cycle in the future, but also volumes, just people lending less as interest rates are higher. So those things are all probably more skewed to the downside than the upside. There are some positives though. The bank valuations are actually okay.
Yes.
We spoke about the capital. They've got lots of capital, so there may be some capital management going forward as well. And the economy has actually held up really well. So it's not like we're facing some big cliff of losses coming.
Yes.
But the net of it is, we've got earnings downgrades, risks are elevated. That suggests being underweight the banks as we are. But I wouldn't want to say that there's this huge earnings risk in front of us and it's a huge cliff, because I don't think that's the case either.
Yes, so it's more cautious stance than a concerned
That's right.
stance.
Yep.
Okay, well, thank you very much, Andrew. Thank you for listening. For more information, please visit our website on alphinity.com.au. Thank you.
Thank you.